Equity market neutral strategy. Because of legal requirements and fund restrictions, traditional equity funds are usually limited to investing in long positions. This means that they benefit from rising markets and, on the flip side, that they lose money when the market goes down. But financial history has shown, time and again, that the stock market is not a one-way street. Over the past 100 years, there have been more than 30 boom and bust cycles on the New York Stock Exchange alone. The average loss in any one of these bear market periods has been about 30%. Following the great crash of 1929, investors lost up to 86%. More recently, twice over in the past 10 years, investors have been hit with losses of 50% or more. It is an unfortunate reality that investors who bet on rising markets, for example, by investing in conventional equity funds with major long positions, will regularly face tough market periods and lose part of their capital. That's not exactly the outcome you were hoping for. Is there another way? Yes, with equity market neutral strategies. In the year 1949, Alfred Winslow Jones had the breakthrough idea of a completely new and revolutionary approach to investing. He bought individual stocks and hedged those positions by selling other stocks short, thereby protecting against market drops. With this innovation, Jones was able to profit, not only when the market was going up, but also when it was headed down. This was the birth of equity market neutral investing. With this simple but clever strategy, Alfred Winslow Jones was able to generate consistent gains in sideways, bull, and the toughest bear markets. Over a period of 34 years, he posted net losses in only 3 years, a track record that few could match. The guiding principle of any equity market neutral strategy is to minimize market risk. In contrast to conventional funds, equity market neutral funds are not under any pressure to be invested in any particular market phase. They look for attractive investment opportunities, and if they don't find them, they wait. Because they're not forced to put the bulk of their assets into long positions, the performance of equity market neutral strategies is very different from the major stock market indices, and generally with a lot less of the gut-wrenching ups and downs. Low volatility and virtually no correlation to other asset classes make equity market neutral strategies an effective diversifier for less risk and more return in any portfolio. The equity market neutral strategy is all about producing consistent, absolute returns with the least possible volatility across all kinds of market environments. Perhaps Alfred Winslow Jones was trying to tell us something with his middle name. Slow and steady wins the race.